The CEO of OpenAI, the guy at the very center of the AI revolution, recently warned that investors are getting a little overexcited about AI, comparing today's market to the dot-com bubble, but he's only telling you half the story. While tech giants are striking multi-billion dollar deals and pushing AI valuations into the trillions, a recent and sobering MIT report reveals a shocking truth. In their study, 95% of corporate AI projects are failing to generate any real return. This isn't just some market correction waiting in the wings. This is the inside story of how corporate hype is blowing up a fragile, multi trillion-dollar bubble that could cost investors everything. The numbers are staggering, the promises are intoxicating, and the gap between them is the biggest financial story of our time. This is the $200 billion AI scam. Let's be honest. We are living in an age of unbelievable tech hype. Artificial intelligence isn't a sci fi concept anymore. It's being pitched as the single biggest driver of the global economy. The numbers are almost too big to wrap your head around. Global investment in AI is on track to shatter all records, with some projections showing it could top $1 trillion by 2029. The stock market is ground zero for this new gold rush, and at the center of it all is Nvidia, a company that used to be known for making graphics cards for video games. Today, it's one of the most valuable companies on the planet, with a market cap that has rocketed past $4.5 trillion. To put that into perspective, that one company is now worth more than the entire stock markets of Canada and Mexico combined. This isn't just a tech story, it's a full-blown market phenomenon. The so-called Magnificent Seven tech stocks, Apple, Microsoft, Google, Amazon, Meta, Tesla, and Nvidia, are driving nearly all the stock market's gains. That kind of concentration of wealth and risk should sound familiar. It echoes some of the most dangerous moments in financial history. This whole frenzy is fueled by one simple, powerful story that AI will unlock trillions of dollars in productivity and kick off a new wave of economic growth. Every CEO, every investor, and every government is terrified of being left behind. This fear of missing out, FOMO, has created a tidal wave of cash, all chasing the promise of AI. But here's the problem, the real core of the scam. The hype is writing checks that reality can't cash. While valuations are soaring into the stratosphere, the actual tangible revenue is lagging way, way behind. Companies are being valued not on what they're earning now, but on some distant, dreamlike vision of the future. This is the classic signature of a speculative bubble. And when bubbles burst, the consequences are devastating. It's not just numbers on a screen, it's retirements wiped out, jobs lost, and innovation getting stalled for years. The stakes could not be higher. The question we have to ask isn't if this bubble will pop, but when and what's going to be left when it does. So, how did we get to this cliff edge? You just have to follow the money. And in the world of AI, the money flows in a dizzying, self-reinforcing loop. This isn't some grassroots movement. It's a top-down gold rush engineered by the biggest corporations in the world. It all starts with the infrastructure. Building the brains for AI is one of the most expensive projects in human history. It takes these massive specialized buildings called data centers, stuffed with tens of thousands of power-hungry computer chips. The spending on this alone is astronomical. In 2025, companies are on track to spend a staggering $364 billion on AI data centers. That's more than the entire GDP of many countries, all spent on building the physical foundation for a technology that still has to prove it can make a profit. McKinsey thinks that by 2030, the world will need to have invested a mind-boggling $6.7 trillion in new data centers just to keep up. Tech giants like Microsoft, Google, Amazon, and Meta are locked in an arms race, each one announcing spending plans that sound more like a government budget. Microsoft is talking about spending $100 billion in the next fiscal year. Alphabet, Google's parent company, is looking at $85 billion. Amazon, another $100 billion. This isn't just investment, it's an all-out declaration of war. No CEO can afford to go to their shareholders and say they're dialing back on AI, because right now that would be seen as admitting defeat. But here's where the story gets tricky. A huge chunk of this money isn't creating new value. It's just getting passed between the tech giants themselves. Take the relationship between Microsoft and OpenAI. Microsoft has poured over $13 billion into OpenAI, but a big piece of that investment is just cloud computing credits for Microsoft's own Azure platform. So OpenAI uses this money to pay Microsoft for the massive computing power it needs. This makes Azure's revenue look great, making Microsoft look stronger, and it lets OpenAI build its tech, which in turn justifies its own insane valuation. Money is changing hands, sure, but it's often staying within the same tiny circle of companies. It's a closed loop of hype where everyone's valuation is propped up by investments from the very companies that benefit from those inflated valuations. This creates a powerful illusion of unstoppable growth. When we hear about a $10 billion investment, we assume it's a sign of incredible progress and future profits. What we don't see is the clever financial engineering that's propping the whole thing up. It's a hype machine, and it's running at full speed, burning through hundreds of billions of dollars a year in a desperate race to build a future that might not show up as promised. If you were paying attention to the markets at the turn of the millennium, this all probably feels eerily familiar. The breathless predictions, the sky high valuations for companies with no profits, the belief that this time it's different, it's a perfect replay of the dot-com bubble, and it's not just a feeling. The parallels are so obvious that even the leaders of the AI boom, like OpenAI's Sam Altman and Amazon's Jeff Bezos, have openly warned about it. Billionaire investor Paul Tudor Jones flat out said today's market looks a lot like the late 90s, warning that the excitement is pushing valuations to levels that just aren't sustainable. Let's break it down. First, you have the narrative. In the late 90s, the story was that the internet would change everything. Any company with .com in its name was treated like a lottery ticket. Today, AI has replaced .com. The story is that AI is such a massive paradigm shift that the old rules of valuing a company just don't apply anymore. Second, the metrics. During the dot-com boom, analysts famously threw out traditional metrics like the price to earnings ratio. Since so many tech companies had no earnings, they just invented new, more flattering metrics like price per click or eyeballs. We're seeing the exact same thing today. A lot of AI companies are burning through cash, so talking about profits is inconvenient. Instead, the conversation shifts to things like compute power, model parameters, or potential market size, abstract ideas that are almost impossible to connect to actual financial performance. Third, the market concentration. The dot-com bubble was defined by a handful of tech superstars, the four horsemen, Cisco, Dell, Intel, and Microsoft, that seemed to defy gravity. Today, as we've said, the market's fate is tied to the Magnificent Seven. The concentration is so extreme that some economists are warning the current AI bubble is even more inflated than the dot-com one. One research firm even claimed that this AI bubble is significantly larger than both the dot-com bubble and the 2008 real estate bubble that sparked a global financial crisis. And finally, you have the investor mania. Just like in the late 90s, there's a feeling that you have to get in on the action or you'll miss the opportunity of a lifetime. This drives a herd mentality where money floods into the sector not based on careful analysis, but on the fear of being left out. Jeff Bezos described this perfectly, noting that during bubbles, every idea, good and bad, gets funded and investors can't tell the difference. The dot-com bubble didn't burst because the internet wasn't a big deal. It absolutely was. It burst because the hype and the valuations got years, even decades ahead of the actual profits. Companies worth billions went bankrupt overnight, not because their ideas were bad, but because they couldn't make money fast enough to stay alive. The ghost of the dot-com era is a warning. A world-changing technology and a catastrophic financial bubble are not mutually exclusive. In fact, they often go hand in hand. Okay, with hundreds of billions being poured into AI, you have to ask the main question, where's the money? Where is the real sustainable revenue that justifies these trillion-dollar valuations? When you start to actually look for it, you find a disturbing pattern of high-profile failures, unprofitable successes, and a whole lot of corporate projects that are just bleeding cash. This isn't just a theory. A bombshell 2025 study from MIT's Media Lab called the Gen AI Divide dropped a truly sobering statistic. After looking at over 300 corporate AI initiatives, they found that a staggering 95% of them failed to produce any measurable return on investment. Let that sink in. For every 20 AI projects a company kicks off, 19 of them are, for all practical purposes, a waste of money. The report found that companies were spending between $30 and $40 billion on this stuff, but only 5% of those projects ever made it into production with any real value. The main reason wasn't that the tech was bad, it was that they couldn't fit it into how they actually do business, and nobody had the skills to manage it. We've seen this play out in public with some pretty embarrassing results. Just look at McDonald's. In 2021, the company launched a big partnership with IBM to create an AI-powered drive-thru. The promise was efficiency, speed, and lower labor costs. The reality was a viral comedy of errors. Customers posted videos of the AI adding bacon to their ice cream, messing up an order to the tune of hundreds of dollars in chicken nuggets, or just getting stuck in frustrating loops. After years of testing and an internal report showing the system's accuracy accuracy was way below their 95% target, McDonald's finally pulled the plug in 2024. It was a very public admission that applying AI to the messy, unpredictable real world is a lot harder than it looks. But what about the successes? This is where the story gets even weirder. Let's take GitHub Copilot, Microsoft's AI tool that helps developers write code. It's been called a revolutionary product, and it is. It has over 1.3 million paying subscribers and is a huge part of GitHub's revenue growth. On the surface, it's a home run. But when you dig a little deeper, you find a darker truth. According to the Wall Street Journal, Microsoft has been losing a lot of money on each Copilot user. Some estimates from early 2023 suggested an average loss of over $20 per user per month, with some heavy users costing the company as much as $80 a month. The reason is simple. The cost of running the powerful AI models behind Copilot is higher than the $10 or $19 a month they charge for it. So, while it's a huge success in terms of users and even revenue, it might be deeply unprofitable. It's a product with incredible utility, but it's being sold at a loss. This brings us to the epicenter of it all, OpenAI. Here, the paradox is at its most extreme. The company's growth is breathtaking. After hitting $3.7 billion in revenue in 2024, they were on track for something like $12 to $13 billion in 2025. They have millions of paying subscribers. By all accounts, it's a real fast growing business. But the other side of the balance sheet tells a different story. In the first half of 2025 alone, OpenAI reportedly burned through $2.5 billion in cash. The company is projected to burn through as much as $8.5 billion for the full year. These aren't the financials of a stable, profitable company. They're the numbers of an organization in hyper-growth mode, spending whatever it takes to win the market, while its revenue is skyrocketing, its expenses for R&D and just the sheer cost of running its models are rising just as fast. This has led to a valuation that's hard to justify. In late 2025, an employee share sale valued OpenAI at a staggering $500 billion. Is a company, even one with amazing tech and fast-growing revenue, really worth $500 billion when it's burning through billions in cash just to operate? These examples show you the three faces of the AI bubble: the total failures, the unprofitable successes, and the hyper-valued unicorns. Together, they paint a picture of an industry built on shaky financial ground, where hype consistently beats profit. We're about to get into the most important part of this story, the great disconnect that explains why this is all happening and what it means for the future. But first, if you're getting some value out of this breakdown and want to understand the forces shaping our world, take a second to hit that subscribe button and turn on notifications. We go deep like this every week, and you won't want to miss what's coming next. Now, it would be easy to look at all this and just declare the entire AI industry a house of cards. But that's not the whole story. Let's be clear. The technology at the heart of this revolution is very, very real. AI is not the next pets.com. The scam isn't that the technology is fake. The scam is the financial story that's been built around it. There is undeniable, real value being created. And the best example of this is Nvidia. Nvidia is the company making the shovels in this digital gold rush. They design and sell the specialized GPUs that are the essential hardware for running large AI models. Every company, from the biggest tech giant to the smallest startup, needs Nvidia's chips. And because of that, their revenue and profits are explosive and, most importantly, very real. Their spectacular $4.5 trillion valuation isn't built on pure hype. It's built on selling a physical product that's in ridiculous demand. Nvidia is proof that you can make enormous amounts of money in this new economy. Beyond the hardware, there are genuine breakthroughs happening every day that are truly changing the game. AI is speeding up drug discovery, helping scientists develop new materials, optimizing complex supply chains, and generating scientific insights that were impossible just a few years ago. These are not hype-filled promises. They are real-world applications creating real value. And this is where someone like Amazon founder Jeff Bezos comes in with a really interesting take. He has openly said we're in an industrial bubble where excitement is making stock prices get disconnected from reality. But he also argues that this isn't necessarily a bad thing. He compares it to past bubbles like the biotech one in the 90s, where massive investment led to life-saving drugs, even though many of the companies went broke. His point is that even if a lot of investors lose money, the huge wave of cash speeds up innovation, and society ultimately wins from the inventions that survive. In his words, the benefits of AI will be gigantic. So we have to hold two conflicting ideas in our heads at once. The AI bubble is real, it's dangerous, and it's probably going to end badly for a lot of people. But the AI revolution is also real, it's transformative, and it will almost certainly change our world in profound ways. The challenge is telling the two apart. The existence of a real technological shift doesn't justify any and every valuation. And admitting there's a bubble doesn't mean you're dismissing the technology. The most credible view is somewhere in the middle, recognizing the promise while being brutally honest about the financial speculation that has latched onto it. This brings us to the absolute heart of the issue, the core misunderstanding that's fueling this entire $200 billion bubble. It's the great disconnect between productivity and profitability. For the past few years, we've been flooded with studies and corporate announcements talking about the incredible productivity gains from AI. Developers using GitHub Copilot are 30% faster. Call center employees can solve problems 15% more quickly. Marketers can generate ad copy in seconds, not hours. All of this is true. The technology absolutely makes people and teams more productive at certain tasks. And this is where the logic trap is set. The unspoken assumption, the one that holds up every inflated stock price and every multi-billion-dollar investment, is that these productivity gains will automatically turn into profitability gains. But this is a dangerous and often false assumption. Let me give you a simple analogy. Imagine you run a business and you buy every single one of your employees a brand new top of the line computer that's twice as fast as their old one. Now they can answer emails and make spreadsheets faster than ever. You have, without a doubt, made them more productive. But does that mean your company's profits will double? Of course not. The cost of all those new computers might be far more than the value of the little bit of time saved. Your employees might be more efficient, but the business itself could actually be less profitable. This is exactly what's happening with AI in thousands of companies. An AI tool helps a team work faster. That's a clear productivity gain. But if the monthly subscription for that tool, plus the huge, often hidden cost of the computing power needed to run it, is more than the financial value of the time saved, then the company has made a net loss. It has become more productive and less profitable at the very same time. This is the GitHub Copilot paradox on a global scale. We're celebrating productivity, which is visible and easy to measure, while mostly ignoring profitability, which is hidden away in the massive spending budgets of companies like Microsoft and Amazon. The tech giants are basically subsidizing the AI revolution, selling access to these incredible tools at a price that often doesn't cover the true cost, all in a mad dash to capture the market. And that disconnect is the engine of the AI scam. The scam isn't that the tools don't work. They do. The scam is the pervasive and deeply flawed belief that productivity is the same thing as profit. Corporate leaders are investing billions based on the first, while shareholders are expecting returns based on the second. This gap between what's expected and what's real is unsustainable. It's being papered over by venture capital and the huge cash piles of big tech, but at some point the bill will come due. External pressures are already building. Rising interest rates make a burn cash now, profit later strategy much harder to pull off, and the constant threat of new regulations could completely change the financial math overnight. The great disconnect between what AI lets us do and what it actually earns is the fundamental weakness at the heart of this bubble. So, where does that leave us? We started with a stark warning from the leaders of the AI revolution themselves and some shocking data showing a 95% failure rate for corporate AI projects. We walked through the mechanics of the hype machine, seeing a spending frenzy that makes the dot-com era look tame. We saw the ghosts of that past bubble in today's market with its total disregard for traditional metrics and its obsession with a few superstar stocks. We went looking for the missing revenue and found a landscape littered with failures like the McDonald's AI drive-thru and unprofitable successes like GitHub Copilot. We also acknowledge the truth that this is not all a fraud. The technology is real, it's world-changing, and companies like Nvidia are making immense, legitimate profits building the tools for this new age. But we landed on the great central disconnect, the fatal confusion of productivity with profitability. This is the intellectual flaw that this multi-trillion-dollar bubble has been built on. Look, the point of this isn't to spread fear or to dismiss one of the most important technological leaps in human history. It's to give you a critical framework to see what's really going on. The word scam is provocative, sure, but it feels right for a financial story that promises endless riches while ignoring basic business realities. The scam isn't the AI, it's the story being told about the AI. So, the next time you see a headline about a company raising billions for an AI venture or a tech giant announcing a record breaking investment, ask yourself the hard questions. Where is the revenue actually coming from? Who is paying for this, and is the price they're paying leading to a real profit? Is this a genuine business, or is it just another player in the great productivity for profit swap, burning through cash to chase a dream? The AI revolution is here to stay, but the AI bubble is a fragile, temporary thing. Understanding the difference between the two is the key to navigating the turbulent years ahead. What do you think? Are we in the biggest financial bubble in modern history, or is this just the price of admission for a new economic dawn? I really want to hear what you think. Leave your thoughts in the comments below, and if you found this deep dive valuable, please subscribe and share it with someone who needs to see the story behind the hype. Thanks for watching.